Hello friends, today I'm going to talk about mutual funds. I will give you a brief introduction about mutual funds as well as how the people are saving a lot of money using these mutual funds and how does really impact on our life. See, a lot of people will invest in the bank. The bank hardly will give the interest, hardly nowadays 7 to 6%, but most of the people will invest in the banks. Even some people don't know what is a mutual fund, though a lot of people aware of the mutual funds, but they are not investing because there are so many reasons. So I'll try to actually cover few of the points, but not in too much detail. In coming slides, I'm going to explain you. Thank you. So what is a mutual fund? The answer is mutual fund is a professionally managed fund. What is professionally managed? So example, like if if anybody give you like 1 lakh, so where exactly are you going to invest? You'll have a lot of doubts whether to invest in the bank or whether to take the property or whether to buy some gold or invest for your son books or toys or something else. So you have a lot of questions in your mind. So whereas a mutual fund is professionally managed, so the fund manager, he's he knows actually exactly where he need to invest your money, which which type of industry is growing, which type of industry is not growing, what is the future for coming days. So he will have some idea and what are the results of the companies. Considering the facts, these professionals will invest your money in a secure way so that they can give better returns. I repeat, better returns. In general, mutual funds returns will in the range of equity, especially in the range of 12 to it could be 20 25 also. When some mutual funds nowadays are giving returns more than a 50%. If you take DSP, BlackRock, Natural Resources, it is giving more than 50% return. And almost all infrastructure funds, those are giving returns more than 30 to 40%, even more. Even some tax saving mutual funds, these are really good. You will get two advantages. One is you will, by showing these investments, you can say your tax component, that is also your investment. Also these ELSS tax saving mutual funds are giving better returns, almost 18, 12, 18, 15 and more than 20 also is giving returns. These are really good funds. SIP, systematic investment plan. This is the best way of investing your investment into the market. A fixed amount of money periodically invested in a specified mutual fund, like it could be like monthly, fortnight, or quarterly, or half yearly. So if you invest in your amount through a SIP, you'll get a better returns. So SIP claims encouraged disciplined investments, and in the mutual funds, a lot of people will think that redemption it will take a long time and it is very difficult. A lot of confusion is there. So it is very clear, like a bank, how do you go to the bank and give you a check and you'll withdraw, or just fill up a slip and you'll withdraw? In the similar way, we can withdraw online. Simply click a redemption, how many units you want to withdraw, like partial or full. Simply you can withdraw in a single click. you can withdraw your amount. Else just go to your mutual fund office, fill up the form and give to them. It's simple way. The bank, it will, they'll give you immediately, but whereas a mutual fund, it will take 2 to 3 working days. That's only the difference. And please remember, if you are investing within a year, 1 year, that is called short-term investment, and it is on the profit, like on the interest, what do you earn on the interest, only 1% will be taxable. Whereas if you compare with a bank, on the bank, like they're charging, they're giving, you are getting a 6% or 7% returns, but as per your tax slabs applicable, it could be 30%, or it could be 10% or 15%. As per that, the deduction will be there, and you can achieve your financial goals with the SIP. Stock market could be sometimes up, down, doesn't matter. Please go on investing, you'll get a better return. So let's have a direct comparison with mutual fund versus the bank FD. So take the parameters. Rate of return in mutual funds, there is no assured rate of return, but in practical situation, if you take from past 90s, at 2000 or 2010 or 2017, and if you see the historical data, the mutual fund returns are more than 12%, especially equity related. This one, there are debts also. Debt will give the lesser returns, but assured, a kind of assured, not so assured, a kind of assured returns will get. So there is no assured, but you'll get a better returns. Whereas in fixed deposit, when you do the fixed deposit, you'll know the rate, so that applicable for the tenure. Inflation adjustment returns, potentially for high inflation adjusted returns, whereas for FD, usually low inflation adjusted returns. And risk, see, risk, everyone knows, where there is a risk, there is a lot of gain. So there's a medium to high, you can choose the risk also. If you want to take a lesser risk in the mutual fund, you need to invest in the debt mutual funds, but debt mutual funds will give the less return, because there is less risk and less return. And if you choose equity related mutual funds, you'll get higher returns. It could be like 18 to 25%. And in FD, there is no like low risk. And liquidity, high liquidity in mutual funds, fixed deposit, medium to low liquidity. Parameters to withdraw, allowed with exit load. Some type of mutual funds have like exit loads that I told you, like 1% if you withdraw within 1 year. In FD, allowed with penalty, like if you want to withdraw your mutual fund, if you invested for 1 year, if you want to withdraw within a 1 year, like they'll calculate pro rata, and whatever the whatever the rate applicable to that, they'll reduce your rate of interest, and they'll give you cost of investment, management cost, and there's no cost, because a professional is managing your investment. It's like if you are investing like a 2000, it could be like nominal charges, and some mutual funds are charging, but not all mutual funds. It could be like a 2 rupees or 3 rupees, even lesser than that. Actually, the management cost will be there, and GST also, whatever is applicable, will be there. But don't worry about this cost, it is negligible, because your returns are much more as compared to the FD. In FD, there is no cost. And tax status, see, these mutual funds are tax free, and if you invest for within a 1 year, after 1 year, whatever you withdraw, it is tax free. Whereas in ELSS tax saving mutual funds, you need to invest for 3 years. This is a lock-in period. This 3 year whatever you invest, you're not going to withdraw. And FD is taxable as per the tax slab. Let's see directly like how it works for mutual fund versus bank FD. See, if you see a monthly investment of 2000, I just converted into a recurring deposit. So a recurring deposit like a kind of FD only. If you invest recurring deposit 2000 rupees for a period of 20 years, your investment will be like 4.8 lakhs. That will give you like 14.5 lakhs. That will be compounding up of 10%. We take interest rates a little higher side and RD. Whereas in SIP, if you invest 2000 rupees for 20 years, like in your investment again is the same 4.8 lakhs baht. Here a lot of difference. See, the in 20 years your 2000 like monthly investment 4.8 lakhs will become 1.1 crores. Can you believe it? It is 25.22% CAGR return. So this is the power of SIP, and this is the power of a mutual fund. Thank you so much for watching my video. Please share with your friends. Thank you.